I'm going to use a real simple example. And sometimes we do this with even our extremely wealthy clients that have never even seen this before. We show them an investment pyramid. And, the concept of the pyramid, there's a reason why the pyramids have been around for thousands of years, is
Hmm.
because the base is massive. So in investing, the base is safety and security. So no matter what happens, no matter what storm hits in your investment portfolio, you're going to weather the storm if you make that base stronger. So what does that mean? That we may in a portfolio, like in our true wealth portfolios, we may have 50, 60% of the money in a pretty strong position. Now, the good news is we're on the institutional side or the smart money side, so we can still make pretty good returns in there, but making a lot of that money guaranteed, safe, very secure, has very little volatility. And then maybe take the other 40% and take risk with that. That's more of a wealthy of the wealthy investment model. So, like Warren Buffett's a perfect example. Everybody sees him and goes, look at all the money he's investing in all these companies, right? Value
Hmm.
investor. That's all he has. Every single bit of his money sitting in those. No. Right now, actually, he's sitting on a massive amount of cash because he's looking for opportunities and concerned about a market turn. But generally, his portfolio, 50, 60% of it would be in very safe, secure types of investments. And then he can gamble with the rest of it and still make incredible returns and be considered one of the greatest investors of all time.
Yeah. It's funny you mentioned Buffett. We helped a client get a blog article ranked number one for the search term "stay in cash."
Mm,
It was all about Warren Buffett, and it was just a question. This was like 2017, and Warren Buffett was sitting on 100 billion in cash, and people are
yeah,
like, "Look at all the cash he's sitting on. What's the
yeah,
signal?"
yeah.
And they said, "Well, just having that cash allowed him. When he saw a bargain, it's like you're
Yes.
walking down the street and you see somebody has something on sale, and you're like, oh, well, I have the cash to pay for that right now."
Yeah. It doesn't necessarily mean that he's out of the markets because he believes the markets are going to crash tomorrow. There's a number of reasons why wealthy individuals have money in cash. Many of our folks have money in cash because simply for opportunities that will come along.
Yeah.
That's actually a wealthy of the wealthiest strategy. So if you're sitting there, you've got every single penny of your money deployed and a lot of it's illiquid, then you can't take advantage of opportunities as they come. So, and I'm not saying, I think it's a little bit of both with Warren Buffett right now, but he's the one that you've always heard this, and most people have heard this. His first rule of investing is don't lose money, right? His second rule of investing is look at rule number one. Right. So
Yeah.
does that mean the picture that everybody has, and he's investing in all these companies and 100% of his money is at risk? And what if one of these companies goes bad? No, he's doing the smart money strategy. He's got the majority of his money sitting in cash that is there for his base on that pyramid. And then if something really goes wrong, guess what? He's still got his base intact and he
Yep.
can still recover and do well. Whereas a retail investor, like most folks that we see, might have, 70%, I would say, is probably the average that we see of 70% of clients' money when they've been on the retail side, and even very wealthy people when they come to us, and they've maybe been with Fidelity or Edward Jones or one of these retail platforms for a long time, and they've made some decent money, but 70% of it is generally exposed to the equity markets. And they have no clue. They don't
Yeah.
even know that. They're just like, hey, I feel like I'm making money, I'm doing okay, but gosh, I can't believe how much money I lost in 2022. That's
Yeah.
because 70% of your money is sitting there at total exposure. If something really goes bad in the world or the economy, then, they could literally be wiped out. That doesn't happen to the wealthiest of the wealthy. That's why you never see people dropping off the Forbes 100 list in
Right.
droves. It's not like they're rolling the dice and hope that, every year they make 50% return or whatever. You'll see those same people year after year after year that are in the, top 10, 20, 30, 50 on those lists.